Hi there, everybody. This is Jerry speaking. Okay, the first thing I'm going to do is just focus on what happened last week, obviously with the non-farm payroll, the data, much anticipated data. We were expecting a strong-ish number, the ADP data that came out on Wednesday. If you remember, we discussed that on Monday last week. 234,000, quite a strong number, known to be a little bit choppy, volatile, etc. But we weren't disappointed, or certainly the market wasn't disappointed. The non-farm payroll change on Friday, last Friday, came out at 200,000, so quite a bit better than what was expected. But they also revised the previous month up as well. So the net effect was 12,000 better from the previous month and 20,000 better from what was expected on the consensus. So a pretty good performance all in all. What was also interesting, which is something that I've focused on before, is that average hourly earnings has gone up. We're expecting a rise of plus 0.2. This came out at plus 0.3. Not that dramatic, but actually that's something that worries the markets at a time when we're a little bit concerned about inflation, what Trump's done with the tax reform bill. There is a big idea that the inflation will start to rear its ugly head, and something that would really push that forward would be more money in the consumer's pocket. So because of that, we've seen these headlines on Friday after the non-farm payroll data. Bond markets went into a bit of a fit, and there's this article from the FT says the US bond market sell-off deepens after wage growth surges. And so it's sort of fairly self-explanatory, really. But just so you can see it in chart form, what I've got up here, let's just go to it, is the Bund chart. So this is a chart of the German government bond, which is like a bellwether for the European bond markets. But all bond markets are in quite a sharp sell-off at the moment. That includes the UK gilts, German Bund, and US Treasuries. And you can see here from the Bund that this market has fallen quite sharply so far this year and is in quite a significant downtrend now. So with prices going down, that means yields are going up. Yields going up, it basically means that it costs more for the government to borrow money, and that has an effect on all sectors of the of bonds, so that includes corporate bonds. So because of that, you've seen an effect on the stock market as well, and as the price of bonds falls, it starts to make equities perhaps look not quite so inviting with such with relatively the yield, the difference between the low risk bonds and equities start to be called into question, and hence the reason why we saw last Friday, and again remember this is been recorded at 4:30 in the afternoon. This candle may look different come the close, but we've seen a significant fall now from the highs on the S&P from this time last week, the order of about 80 points. So it's quite a pullback. Nope, it is not a hugely significant pullback just yet. We've got a long way to go to even challenge the levels that we were at the turn of this year, which is only, 4.5 weeks away. So please keep that in perspective. So that was last week. You'll also note that we had some fairly dire manufacturing data in the UK. I say dire, maybe not that dire. It's still pretty strong, but it's not as strong as had been, and quite a bit weaker than what was expected. Contrast that with the Institute of Supply and Management data out from the US, came in at 59.1, better than expected. And then we had our construction PMI only just expanding, slightly above 50. 50 and above is expanding. Anything below 50 is contracting. So that's rather tugging at sterling, and it's been quite a move in the dollar up and down last week and sterling. But the consequences of the strong payroll data will be felt in the foreign exchange markets. And if we look at the euro dollar as a proxy for the dollar index, you can see there's been quite a sharp sell-off, and I'll put the 15-minute chart up so you can see after this number at 1:30 on Friday, quite a sharp sell-off from the levels it was trading at for most of the morning up until the data came out at 1:30, around 124.90, 125.00. Sold off all the way down to, well, close to 124.10 really, but you can see at the time of recording this, it was around 124.45. Okay, let's have a look at the data coming out this week. Dominated by the services sector. So we had the manufacturing data out from the US and the UK last week. So it's the services sector. what has been the strongest sector. We're looking for a figure in the UK on Monday around the same as the previous month, 54.1. The equivalent data in the United States that has the additional Institute of Supply Management, ISM, mnemonic with it. Non-manufacturing PMI, curiously put, it is the services sector. And again, this demonstrates the gulf between the two economies. 56.5, very strong services sector out in the US. This week is going to be dominated by central bank announcements, and obviously the key one that drove sterling higher at one stage last week was an idea that perhaps the Bank of England might be raising rates. So Thursday is a very important day for us this week, with the idea that rates, obviously there was a rumour that rates could be going up soon. I don't think they were going to go up this Thursday. Nevertheless, it does sort of bring into focus what the Monetary Policy Committee, the MPC, might say at this juncture. So we'll find out on Thursday at midday, and then any policy statement that accompanies it as well. Other than that, we've also got the Reserve Bank of Australia announcing they raised their rates, I think last month, did they not? Anyway, they're not scheduled to make any changes this month, keeping rates unchanged. Same thing with the New Zealand Central Bank, expected to keep rates unchanged at 1.75%. But they tend to have an effect on the Aussie and the Kiwis, so obviously that is something to keep in mind. We will see the effects of it, obviously, from the Reserve Bank of Australia when we get in on Tuesday morning. Other than that, not a lot of data out, really. The various members of those respective banks talking around the time of those monthly policy announcements. But really, other than that, not a lot else to trade off. The regular weekly crude oil data we'll have at 3:30 on Wednesday. We don't actually have any data published here for what's expected, but there was quite a significant build last week. I suspect we're looking for a bit of a drawdown this week, but we'll get confirmation of that when they fill in the blanks here sometime this week. Other than that, manufacturing production data in the UK on Friday, but really I think Brexit seems to take centre stage as usual. Whilst May was away, she had a bit of respite from the constant haranguing by the press and the Brexiteers and the Bramonas, but that's the way it is, isn't it? But for the time being, sterling is actually quite strong. Not so undervalued, I think is a good description.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.